Hello, this is Emory University's presentation of the North Star Casting Company Private Business Valuation Challenge. My name is Albert, and I will be presenting alongside Dolamu and James, and we shall get it started. So this is our team. Again, my name is Albert. I'll be presenting alongside my two partners, Dolamu and James, and we are all from Emory University. So we're going to kick it off here with our executive summary of North Star Casting Company. It's currently a full service provider of aluminum and magnesium die castings, and we can see some of the images here below. In addition to the products depicted in this image, North Star also has a variety of additional products, all of which are truly enabling their market share dominance ever since their founding in 1918 in Chicago by Herschel Birnbaum. And from then, North Star has gone on to have the idea of actually taking 51% into an ESOP, so an employee stock option plan. And our goal here today is to attempt to value that 51% share. And in terms of just some additional information in regards to the capital structure overall, their debt invested capital is 60% and their equity invested capital of North Star is 40%. And the trustee of the ESOP has commissioned the valuation of this company as of September 30th, 2024. And so now moving to a quick snapshot of the five most important company-specific items that we wanted to list here. Again, it's date founded. Their current operating locations are Chicago, Cleveland, and Indianapolis, and all of those locations are IATF certified. The report date for this valuation is November 1st, but again, its effective valuation date is September 30th. And again, it's with a focus of 51% outstanding shares as a part of the ESOP plan. And some additional information regarding the company here. So the competition here on the right, we have a list of a few of the main competitors that North Star faces in regards to the respective direct industry that they're a part of. And some key items in regards to the management's perspective. We just found these important in terms of their expectations into the fiscal year of 2025, and also in regards to their belief in regards to taking that market share within the specialty magnesium casting space. And they consider that a differentiator for them in regards to industry diversification. So this is a summary of our initial valuation, ranging from the football field here, the image on the left. We decided to go with the income approach, so using a DCF, a discounted cash flow method. And we also use the market approach method as well. And so reading from left to right here, we see the matriculation of enterprise value all the way down to our equity value for the 51% ESOP. And that correlates at the end of the day to roughly a share price of $20.09 to $28.64 dollars. And we can see some additional metrics here on the right in regards to marketability discount, implied EBITDA multiples, and terminal growth rate. And with that, I will wrap the industry outlook and have one of my partners take over.
Yeah, thanks, Albert. So there are a number of things that are going on in the industry right now that North Star is participating in. Number one is a theme around consolidation. The industry for die casting has seen significant consolidation, with over 1,000 shops in 1960 shrinking to just under 400 in 2018. And also, we see two of their biggest competitors are suffering from this as well. So that'll be going forward, potential revenue gains that the company can experience. Another theme is the lightweight materials that industries that they serve are currently seeing an uptick in. North Star has been able to position themselves to take advantage of this by having a completely magnesium location in their Cleveland location, completely filtered out to adapt to this growing customer base for like lightweight materials. Additionally, the customer concentration. This is one factor that North Star has been mitigating as they look to decrease their sales for the total customers in Pacific industry to under 20%. So this has been beneficial as the automotive industry has been cyclical in recent times. As I just spoke on the magnesium casting, North Star has been pushing to specialize in this. They completely renovated a facility to fully adapt to this capability, and have led them to be very compatible, very 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 competitive in this landscape. So moving along is the quality of earnings. So we wanted to first take a look at the historical numbers just to gain confidence in management's numbers before we took a look at the projections. So we looked at this in three different avenues, starting first with the definitional adjustments. What we did here was strip out any um, any um, any income or expenses that were not associated with the core operations of the company. So we stripped out the interest expenses and as well as the interest income. We stripped out any taxation involved and also gains in depreciation on assets to give us a clearer picture of the company's performance. Management pointed out in their files that they had two different areas where they recognized adjustments. One was for transaction expenses that were due to like M&A activity that they had in fiscal year 21 and 22 that we stripped out, and any associated advisory fees associated with that M&A activity. Number two was the removal of non-cash compensation related to the company's employee stock operation plan that was implemented in 21. So we stripped those out as well. And lastly is our diligence adjustments. Going through management historical figures, we saw some big upticks in a couple of different areas around legal and professional and also advertising expenses. And we were able to normalize those looking at the historical averages in precedent years and also future years where we saw normal levels of activity. So we just normalized that activity to get a clearer picture of the company's performance. And moving along is the company's historical income statement. So here, the company's has been seeing some cyclical or in some fluctuations in their revenue. This is primarily due to the reliance on the automotive industry, and the company has made transitions to diversify more into the medical and agriculture sectors. More recently, the company won a $5.8 million contract that is expected to generate new business into 2024 and also ahead. As far as from an operational standpoint, North Star has been officially managing their operating expenses. Their operating expenses at a plant level, and they also make their plant managers accountable for profitability. And this has led to operational efficiencies and has led to also higher margins and a consistent budget achievement year over year. Also, looking at the firm through a profitability lens, here we have some KPIs down below. The company has been able to achieve uh, well, in 2024 the company was able to achieve their budgeted performance, which signals that the company has been, adequately forecasting and projecting their financials in line with how they were able to achieve them as well. So we gained significant confidence by looking at 2024 and how management was able to hit those targets around their EBITDA and also their gross margins. Moving on to the forecast. So we spent a significant amount of time here analyzing management's forecast. Starting with revenue, we felt that the revenue projections were reasonable given that they had some new recent wins in business coming from the medical and agriculture industries. Management was able to identify sources of all the forecasted revenues, which gave us a lot of confidence in this revenue number. And also with the experiencing with the competitive landscape in the industry right now, their top competitors are expected to undergo bankruptcy here soon. So we see some revenue wins coming out of that as well. In terms of growth profit, the company has been moving towards more operational efficiencies in direct labor consolidation and favorable product mixes, particularly due to their transformation around the magnesium work that they do, which adds a higher value content across their operation landscapes. Um, and in terms of the operating expenses and depreciation, we did see some areas of concern here around how they were treating it and classifying the expenses into both categories. So to work this out, we introduced a rich premium in our WAC calculations that we would further discuss later, just to categorize these correctly and give a accurate depiction in our valuation. Some KPIs that are notable here. The gross margin is forecasted to be 20% higher than our historical that we've seen in historic years, and this is primarily due to the new business wins that affect the top line, and also those operational efficiencies that affect that bottom line profitability. So that's a big drivers in the gross margin percentage. In terms of EBITDA margin percentage, the company is in a good position to see marginal improvement due to the profitability from its core plants, especially in Cleveland, due to the magnesium concentration there. The Cleveland plant has been able to transition well and has been a big driver of the company's organization improvement around their operation infrastructure. And I'll pass it along to my colleague to talk about the different valuation methodologies.
Yeah, thank you so much, James. Yeah, so we've talked about I think my colleague Halbert mentioned that we adopted the income approach and the market approach to estimate the fair value of the of North Star Casting Company. And of course the income approach is simply saying that the value of a company is the present value of all the estimated future cash flows. And also as we mentioned along the slide earlier that the company is expected to continue to operate into perpetuity. So we have adopted the perpetuity approach in terms of estimating the terminal value and then discounting it back to present value to estimate the value of the company. And then from there, we estimated the 51% equity stake, the value of the 51% equity stake of ESOP. Meaning employee stock option plan. And we also look at the market approach. Under the market approach, we specifically used the guideline transaction method, and we sourced our multiple from business valuation resources, which we got access to. And then in looking at in sourcing the transactions that we adopted, which we look back from 2019 to 2024, looking at the transactions that have occurred in the die casting industry. Um, so moving on to the next page, I'm simply talking about the things we did under the income approach. We started with our revenue. We estimated our EBITDA. Again, we have solely relied on management forecast for this particular approach. Like my colleague James mentioned earlier, we were sort of not comfortable with the OPEX operating expenses forecast, and then what we did was to adjust for that and using the company specific risk premium, which I will talk about later. So we really didn't adjust management forecast because we are largely comfortable with almost every other thing except the operating expenses. So and again in the case it was mentioned that the company is elected to be is going to be elected to be taxed under X Corp, which means that the company is currently not paying tax at the company level, but at the individual shareholder level. But again, because we are trying to estimate the fair value of what the company is, we felt it's appropriate to bring in taxation because if this company is to merge or being acquired by another company, they will want to see the tax effect of what is the transaction would be. And so for that instance, for that particular reason, we have included taxation in estimating our free cash flow to firm, right? And then we adopted the marginal tax rate applicable in the US of 21%. So what we did after getting our free cash flow, and then we estimated our terminal value. So please go back to the former slide. Yeah, so we estimated our terminal value. We discounted that to the back to present value, and then we also included a marketability discount. And this is because the company we are currently looking at, this not Star Casting Company, is a private company, and then of course for the fact that it is not, it's the company may not be trading the shares of the company may not be easily available in the secondary market, and then it is appropriate for us to include a marketability discount, and we based our marketability the marketability discount that we used on the marketability discount available on the business valuation resources. And then we also try to sensitize our analysis using WACC and the terminal growth rate. We sensitized using 0.5% adjustment. This is assuming that what if the WACC changes by 0.5%? How is it going to affect the enterprise value, the equity value um of the 51%, which is what we have done in this instance. Sorry, which is how it's going to affect the enterprise value, I mean to say. Moving on to the next slide. Yeah, so this is just a summary of our income approach, how we arrived at the $20.1 to $28 that my colleague mentioned earlier, as the share price for trading the ESOP, the shares of employees in the ESOP. And then we have a list of the key assumptions that we made in order to arrive at the value we are proposing. Moving on to the next slide. Yeah, so in the next slide, and we just to sort of explain how we derived the our cost of capital for the so we use the cost of equity and the cost of debt. We sort of find the weighted average of both cost of equity and cost of debt. In estimating the cost of equity, we adopted the capital asset pricing model. So we started from the risk-free rate as at the risk-free rates applicable as at the valuation date, which is 30th of September 2024. And then we adjusted that for the beta for the systematic risk, and then we included equity risk premium. And again, we included size premium, and then we included company-specific risk premium. Again, this is just to sort of analyze, for the risk to adjust for the risk that we are seeing in management forecast. We also did the same thing for our cost of debt. We started with our risk-free rate. We included spread, and then we got our spread from the spread that is currently applicable on corporate bond as at again the valuation date. And then we adjusted this. We arrived at our pre-tax cost of debt. We adjusted for marginal tax rate of 21%. So I arrive at our post-tax cost of debt of 3.9%, ranging from 3.4% to 4.5%. And then weighted this cost of equity and cost of debt with equity to invested capital and debt to invested capital, which resulted in weighted average cost of capital of 13.3 to 13.9%. So moving on to the next slide. Yeah, so this is just simply explaining how we arrived at our cost of company-specific risk premium. What we did was to estimate a notional cash flow and sort of try to adjust the EBITDA if the EBITDA was forecasted based on how the company has performed historically. So this resulted in cost of in company-specific risk premium of about 11.3, which we have considered in our WACC computation. Next slide, please. Moving on to the next slide. Yeah, so again, moving to the market approach. So under the market approach, like we mentioned, we adopted the market value to invested capital, and then we adjusted for real estate assets and net working capital. And this is based on the understanding that business valuation resources in estimating the market's value to investment capital to EBITDA on business valuation resources, the real estate assets and net working capital are not included in the multiple. So after arriving at our enterprise value, we adjusted for real estate assets and net working capital, and then we also adjusted for net debt to arrive at the equity value on a controlling non-marketable basis. Again, we adjusted for discounts for lack of marketability, just to make sure that we are getting at the equity value on a controlling non-marketable basis. And then when we did the market approach resulted in a valuation of 4.7 million to 5.6 million for 51% equity stake. ESOP's equity stake in North Star Casting Company, and then this resulted in a share price of $21 to $25. Again, the market approach is just to corroborate the value we arrived at under the income approach, and then based on what we have done, we are comfortable with the price we are proposing for the per share value of not star casting company. So this is the valuation we are proposing. Next slide, please. Yeah, so this is to give an indication of how with these multiples that we selected, and then how we arrive at a high and low range under the market approach. So we looked at the average, which is the mean, and we also look at the median to form the high and low end of our valuation under the market approach. I think this is where we'll be stopping. Thank you.